Hello, everybody. Stephen Mead here with Domicile Real Estate. This is our weekly Southern California housing market update. Once again, my name is Stephen Mead with Domicile Real estate for people who love houses. You might notice I'm wearing a badge. Why am I wearing a badge? Because I am at the California Association of Realtors conference here in Anaheim, but I thought I would take a couple minutes away to kind of go over our stats this week and talk about something that I think has been on my mind, and it's probably been on yours if you follow the market. So the big news in the last week has been that interest rates rose, honestly, a decent amount in a 1 week time period. And an eighth of a percentage point doesn't sound like a lot, and really it's not a lot, but it is a lot in a 1 week period. If you watch our first time buyer or entry level buyer market update, we've talked a little bit about this. But I've had a chance to do a little bit more numerical work, and I wanted to kind of share that with you. One of the things is I talk to a lot of colleagues in this business. We trade articles back and forth. We talk about things economically. I know Chapman University in Orange has a Southern California housing market forecast out. I think they're saying that they think interest rates are going to go up, and that'll be at some point a 10 to 15% drop in prices. I think that's absolutely possible. I don't think that that's terribly likely, and I'm going to say why. There is another report that someone sent me, and I might even do a video just on this because I find it so fascinating. There's an economist, I think his name is Jim Doty. Is it Jim Doty? No, Jim Doty's at Chapman. An economist who says that 80% of America's home price gains since 1990 are the result of low interest rates and not of natural appreciation. I've run the numbers in Southern California, and while that 80% figure might be possible on a national level, it's not true in Southern California. It turns out in Southern California, it's a little bit more like 50-50. 50% of our housing price increases have been a result of interest rates dropping since 1990, and the other 50% of those increases have basically been because of wage growth and long-term trends where people are spending a little bit more of a higher percentage of their income on housing because we are in a housing shortage. One little corollary to this, though, and I'm going to just talk about this for a second, and then we're going to get into the stats. I don't want to geek out too much, but that got me thinking. If the national perspective is that 80% of home gains have been caused by dropping interest rates, but in Southern California, that only explains about 50% of the home gains. What does that mean about where housing prices are in Southern California relative to the rest of the country? And I think what is fascinating to me is this difference between psychologically high home prices, which I think is something that we're all maybe experiencing. We talk about whatever sold for $1 million, we can't believe it, versus sort of like real affordability, high home prices. And I actually have a theory. I haven't run all the numbers on this, but I think I might in the next week or so and make a special video on this just for you guys. I think that as a whole, while California is an expensive home market, California has always been expensive home market, at least for the last 25 years or so. I think other parts of the country are actually a lot more overpriced than California. And that's kind of my hypothesis, and I have a couple reasons for that. One is that I think California has a lot of wage growth to support these home price increases. I think a lot of other areas have not seen that same wage growth. They haven't seen that same rental growth. So the home price growth is a little out of the ordinary. Anyhow, just kind of a preview of something else that we're kind of working on. But let's jump into those stats, because now that we are firmly in October, we are definitely in fall. We're seeing kind of some interesting results, and I want to share those with you real quick. So we'll back up here to the beginning of our slides. First off is total active listings, right? This is our active inventory under $1 million and between $1 and $2 million. And what do we notice? That inventory actually peaked in July for our 1 to 2 million category, and it's been on this little bit of a decline. Where are we right now? Well, we're right about where we were, in January of this year. We've seen a little bit of a decline, not nearly as bad as we were in the spring. And it's kind of a similar story up here, maybe a little bit better. Here we peaked more in August, And then we've seen this inventory level dropping, still much better than we were throughout the spring period. But we're starting to approach that number towards the end of the year. This is actually pretty normal, folks. I think the level of inventory might not be normal, but this pattern of going into a fall is pretty normal. I like to actually get to save when things are normal. It reduces my heartburn a little bit. If we look here, what are the hold on here. What are the new listings that have come up in the last 14 days, right? And if we're looking here, this is something else that's kind of interesting. It kind of explains a little bit of why this inventory is dropping to some degree. This is pretty normal, again, to see in the fall, fewer homes come on the market. There are a lot of reasons why people don't want to move as much as they in the fall as they do in the spring and the summer. We see kind of this constant summer level of inventory in this window, and now it's dropped and it's kind of heading back to a level that we last saw back here in January. That is for our under $1 million level. We're looking at that luxury market, that 1 to 2 million. It's still a little bit better, but even that's really started to taper off. And I think we're going to see that continue through the end of the year. That's a pretty normal sort of shape of this curve, is that it rises through the summer and then falls into the fall. Now, if this represents our supply side of the equation, of course, we are very interested in the demand side of the equation. Is demand falling, and is it falling by the same amount? And well, guess what? Demand is falling, but it's not quite the same curve. If we're looking under 1 million, demand actually peaked around March of this year, maybe May, if you kind of look at this as a plateau. And then it's been on a very gentle decline as we've headed through the summer. This is not really unexpected, right? I think we can make an argument that homes were underpriced through the spring. Prices jumped to meet that. And then as we headed towards that end of the year, as that sort of price where they should be and where they are, as those get together, we see that demand starts to wane a little bit. In fact, I'm going to go off screen share just for a second. So, if you look at it this way, right? Let's suppose right now the price of gas is $5. If you open up a gas station and you put gas at $1 a gallon, what's going to happen, right? You're going to have lines out the door. We can call that multiple offers, right? You're going to have lines out the door. And what's going to happen eventually? Well, if you're at the gas station, you might start increasing that gas price. And as you start increasing it, those lines get a little bit shorter, and then you eventually reach a point, right, where there's one person for every gas pump. And I think if we look at what's happening here in this under 1 million category, that really is kind of what we're seeing, is that as those prices have risen throughout the summer, demand has cooled off a little bit as we get closer to that sort of ideal number. But I just want to show you what a tight range we're in. We're just below 3,000 houses, maybe call this 2,800 houses. Where we were at our peak, 3,200 houses. It's maybe a 10% swing in demand. It's really not a huge difference in the number of houses that are closing. We look at our 1 to 2 million, yes, demand is waning a little bit, but not really against where it's been for most of the spring and the summer. Now, how do we reconcile supply and demand? We do that with an absorption rate. And if we look here, I think that really tells the story of, despite slackening demand, why are we not seeing it be a lot easier to buy a home? Well, in our under 1 million category, we are riding right here, just a hint under 90% of our absorption rate. And remember what we've been fond of saying, right? 70 to 80% is a buyer's market, 80 to 90 is a very strong buyer's market, and 90 plus is just kind of an insane circus level market. Look where we are. And look where we are compared to the rest of the year. This is actually still a very strong market in terms of what's coming on the market and how fast is it getting absorbed. If you look here for our 1 to 2 million, we see a little bit of a reduction last week, but there's kind of some variations week to week. I'm still going to call this very, very strong demand. We're in the 80s. Now, if we take a look in that rearview mirror, looking back 4 to 6 weeks ago, what do we see? An uptick in prices at the low end, a little bit of an uptick in the median, and a fairly big rebound in that luxury market. Do I think prices are still going up rapidly? No, I think we're following this curve. Look at luxury prices. Look at what happened. The spring was very strong for all these price categories, and then kind of more gentle increases as we headed into the fall. I think we're still seeing that exact same arrangement. We're looking at what we call inflationary increases, right? If inflation is 3 to 4%, we would expect home prices to be kind of in that same window and that same bubble. Now, here's our percent active after 14 days. That says if a house went on the market, what is its likelihood in that first 14 days of still being available? Or if we looked at all the homes that came on the market in the last 14 days, how many are left? Well, when these numbers go up, that means a less competitive market. I think what we're seeing is what I call demand compression. What is demand compression? Well, in a broad-based demand, right? Broad, it means that it doesn't matter what you put on the market, it's going to sell. Demand compression means that those top 20% listings are going to get 80% of the attention. What happens when you have brand compression? Well, that 14-day measurement that we just showed, that goes up, and so does days on market. It means buyers are being pickier. And if we look at this list to close ratio, I've talked on a couple of occasions and I've said, what is this close to list ratio? Well, what it really is measuring is the difference between where sellers think the market is and where buyers are willing to go. And I said, once we hit 4%, I said, I think this is going to start easing back down towards 100%. And while this is a very jagged curve, look what's happening. We peaked right around here in June, and now we are starting to head back towards that 100% of list price. Now, let's think about what this means in absolute terms. It means on average, for homes under $1 million, on average, that home will sell for 2% above list price. Obviously, that means some will sell for a lot more than list price, and others might even sell for under list price, but this is the average in the marketplace. Now, what did I mention about days on market for new contracts? I mentioned that in a compressed demand market, which is what I think we're in, where buyers are pickier, they don't want any house, they want the right house, we're going to see those numbers go up a little bit on average. And what are we seeing? Those numbers are going up a little bit. This is also a very normal thing that tends to happen during our fall period. If we take a look back to last year, to December, gosh, our days on market was 36, 37 days for under $1 million. Where is it today? Still in the low 20s. Where was our average days on market for new contracts? 55 for 1 to 2 million. Where is it today? 29. So we do normally expect this to kind of go up as we head in towards the end of the year, and that's exactly what it is doing. Let's take a look at affordability. Interest rates went up. What is happening to affordability? I've kind of talked about that notion that our market was underpriced, and then it kind of rose up to meet this equilibrium, right? And when homes are going up as fast as wages are going up, we call that kind of inflationary growth. When we look at that here, we're still in that window. Now, we did hit a little bit of a bigger number. I think this looks like about 114%. But let's be honest, the market is largely absorbing that interest rate increase. The question is, how fast are interest rates going up? And speaking of interest rates, here we are. Let's look at the graph as we've seen it, coming back here to June of 2018, where we were just over 4.5%, and then charting through 2021. We are not at the high point. At one point, we're at around 3.2% here in the spring, but we see this big kind of uptick here. The question is, how fast are these rates going to go up? And I'm going to go off screen share for a second. If rates move quickly and that dramatically affects affordability of buyers, that can sort of be a bit of a shock to the system, right? And it can have kind of all kinds of weird sort of psychological market effects that can slow a market down. But if those rates rise fairly slowly, in fact, slow enough that just wage and inflationary increases, it just absorbs them. I ran some numbers, and even if interest rates went to 6.3%, right, which is more than they've been in the last 3 years, if they went to 6.3%, but they did it over 3 years, we still would only see at the end of that 3 years only a 10 or a 15% reduction in price. And I think that would keep us around the same affordability as we are at today. So this really depends on how fast and how quickly these interest rates move. It's not just where they go, but how long they take to get there. And that's going to have a profound effect on where our market is going forward. Now, one other thing that I want to talk about is some notion of the strategy of, well, should I wait for interest rates to rise, buy a house where the rates are high and maybe the price is relieved a little bit? That's definitely a strategy, but it's a risky one, right? Because if these rates move slowly, all you're going to see is the prices remain largely the same. And when I say largely the same, I mean plus or minus 5%, right? So we're allowing some variation. Prices never really stay entirely the same. We do have seasonality in our market. So a lot of things to think about and a lot of things to watch on that interest rate front, because that really is going to dictate sort of kind of the flavor of the market of the next couple of months. Anyhow, thank you guys for watching so much. Don't forget to like, subscribe, and smash that notification bell. Absolutely. We love doing these videos. We love your questions, comments. If you would like real estate advice in the Southern California area and you'd like to work with us, absolutely reach out. We would love to work with you. Stay tuned this week. We will be doing one of our architectural videos on Thursday, and then we will also be doing our entry-level market update on Friday. So thanks so much for watching, everybody. We'll talk to you real soon.